Welcome back to our Monetary Policy Special. We've been speaking with SBI Chairman Dinesh Khara, Samiran Chakrabarti, Chief Economist at Citi, Mridul Sagar, Professor at IIM Kozhikode and former MPC member, and B. Prasanna, Head of Global Markets at ICICI. Gentlemen, thank you very much for your patience. Well, Samiran, are you in sync with the inflation forecast not changing at all in spite of 2 ugly months? And are you in sync? Do you agree with their next year-end forecast? 4.3 sounds very good. Rate cut expectations?
So, Latha, first on the FY24 forecast, our numbers and RBI's numbers are coincidentally now exactly the same. So, we are also expecting a 5.4% average for FY24. For FY25, we have to understand that these forecasts come out of structural models where it's very difficult to bring in the element of these supply side shocks. So we have to assume that this is happening on the back of everything behaving very nicely. And that's where the inflation numbers also look to be quite good, average 4.5% for the full year, and as you were mentioning, 4.3% by Q4 of next year. But what struck me as interesting was that in the assumptions, the RBI has taken a 3% global GDP growth assumption for 2024 vis-a-vis the City House view of 1.7%. So that might be to some extent pushing up the GDP growth forecast for next year, and to that extent might be keeping the inflation numbers even higher than what it could be if global growth actually comes off more rapidly next year.
Oh, so you're in sync with their, I mean, if anything, the inflation could come down. Mridul, 6.5% next year looks a little too tall. We hear that the commercial real estate in the US is in danger, China is in a debt deflation loop. Are we being ambitious?
As a baseline, does look a trifle high, not much high, but trifle higher than what it could be. So we have to be mindful also of the fact that if you see the assumptions in the monetary policy report, what were there in April and what have come now out in October, the only significant change is the monsoon. So 6% below long period average. Will it have no effect on growth? I am not too sure. Though there was this issue that rural demand is reviving, that was there in the previous policy also. So we really need to see whether rural demand is really reviving. Otherwise, 6.5% does look a trifle high given the global environment we are in. And this is the baseline. So that's it could also come in for some shocks, especially on the global side. The political upheaval which could happen, say, post the US elections could be substantial on either side. So we could either have a resolution of Ukraine or we could have a worsening situation. So
exacerbation, yeah. That's right. That's right. Mr. Khara, I wanted to ask you about these unsecured loans. Again, the RBI left it with a warning, and your former colleague, Mr. Swaminathan, said that we are only giving an advisory. But if it is not, he did, and he left it at that. So are you expecting that at some point RBI may, increase provisioning, risk weights? Do you see trouble in the unsecured? Not for y'all again. Please don't tell me we don't have a problem. We have salaried borrowers, but others don't have salaried borrowers.
No, I think when it comes to RBI looks at the system overall. And I would also like to mention that even beyond banks, even NBFCs, etc. So they have to keep the character of such loans across the system. And based upon they have issued these advisories, I think it is for the industry players to really pick up the signals and start tightening their control and follow-up piece at least. Because,
but you don't see trouble now?
Sorry?
You don't see any trouble with unsecured loans?
No, that's something that, it will be a function of the control and follow-up at each of the entity level as compared to the system. But yes, of course, the transmission in the financial sector happens very fast. So contagion is something which actually warrants that all entities should secure themselves well. That is something which I would like to say.
Fair enough. Prasanna, we don't have much time for discussing the currency, But you think this 83.3 will get defended if the rates rise so much, if the yields in the US go up so much? What's your sense about the currency by the year end?
So I think my gut feel, Latha, is we are towards a fag end of the dollar strength that we have witnessed over the last 1 month or so. Recall that it's gone from nearly 100 or lower than 100 to something like 107.50 before it's now come back down to 106 half and all that. Having said that, I think till the year end, there would be in general a positive pressure on dollar because of the high interest rates. Even bond yields, I personally feel that maybe 5% is kind of toppish as far as the US yields are concerned. So I think there is a short term, I think there would be depreciating pressure on emerging market currencies and for the INR as well. But just like every other emerging market central bank which is intervening and preventing its currency from depreciating, RBI is also doing the same, especially with the INR being overvalued on RER terms. So I think it's more of the same. I would put a range of 82.5 to 84.5 kind of a range for the next 3 months. Before the turn of the year, we then have to see what's happening to the dollar rates and whether Fed is likely to cut sometime next year.
Fair. Okay, then that's a very quick question. 10 seconds to the economists. Samiran, cut, next cut.
We have a cut in June 2024, not before that.
Not before that. Mridul, your best guess?
Absolutely what Samiran said.
Oh, okay. Then it looks fairly cheerful for the bond market. Perhaps the grief is brief. Let's see how the OMO timetable comes up. Mr. Khara, Samiran, Prasanna and Mridul, thank you very much indeed for giving us your views on this all-important Reserve Bank monetary policy. We wrap up on this special edition. There's more news and updates lined up for you.